Let me start with a situation that catches a lot of business owners off guard. Sales looks good, customers are buying, orders are coming through. By every measure visible, the business is doing well. Then the bank statement arrives and there's not enough money to cover salary, tax, or supplier payments. That is the moment many business owners realize something important, that being busy is not the same as being financially in control. In this video, I'm going to show you a simple way to build a business budget that helps you make decisions, plan ahead, and avoid nasty surprises. And to make this practical, I have paired this video with a simple monthly budget template that you can fill in as you watch. And let's get into it. A lot of people hear the word budget and think restriction. They think it means cutting back, saying no, or making life difficult. But in business, a budget is not there to limit you. It is there to give you visibility. It helps you see what money you expect to bring in, what money is going out, and whether your plans are realistic. Without a budget, you are often making decisions based on whatever is in the bank today, and that's risky because the balance your account does not tell you what is due next week, what tax is building up, or whether next month will be slower than this one. A good budget gives you an early warning. It helps you spot pressure before it becomes a crisis. That means you have time to act. You can reduce unplanned spending, chase unpaid invoices, delay a purchase, or even review pricing before the problems get worse. Before you start building a budget, you need a clear and honest picture of where your business stands today. And the two documents that shows you that are your profits and loss reports, which is often referred to as income statement, and your balance sheet, your statement of financial position. Your profit and loss report shows what has been happening in your business, how much you've earned, what you've spent, and whether you are actually making a profit. Your balance sheet shows where you stand right now, what the business owns, your assets, what it owes, liabilities, and what is left, equity, after the liabilities are taken away. Now, here's why this matters for budgeting. Your budget is a plan for what you think will happen next. But if your starting point is wrong, your plan will be wrong too. If your records are not up to date or you don't clearly understand your income, cost, and current position, then your budget is not a plan. It's just a guess. So before you build anything, make sure your numbers for the last 3 to 6 months are accurate and up to date. That gives you a solid starting point to build from. If those reports are new to you, do not worry. You can revert to our previous episode on the 5 numbers and asset liabilities and equity. A few terms worth knowing. As you build your budget, there are two terms that are worth understanding. The first is revenue forecasting. This is the process of estimating how much money your business will bring in over a future period instead of guessing or hoping for the best. This is where many business budgets go wrong because owners often budget for the sales they want rather than the sales the evidence supports. If your business has been trading for at least a year, start with your historical data, pull your last 12 months of sales, and look for seasonal patterns. Are there months where business is usually quieter? Are there times of the year where demand goes up, and use that as your baseline? And if you're a new business and you do not have much history yet, be cautious. Build your budget around the conservative revenue estimates, not the best case scenario. The second is your break-even point. This is the level of income you need to cover all your costs before you make any profit. Now, let me show you how to build a simple monthly budget. Open the template. You can see it in the link below. We are going to keep this simple and use one month as our starting point. Now, the step 1 is add your expected sales for the month. Enter the income you realistically expect to receive, not your dream figure, not your best case scenario. There are months that the evidence supports. For example, if you've been earning 6,000 to 7,000 monthly, don't budget for 10,000. Start with a lower, realistic number. If you're a new business, start cautiously. It is better to be pleasantly surprised than being financially exposed. And step 2, add any other income. That might include grants, retainer income, recurring service fees, or other small income streams that support the business. Then total the income. Step 3, list your fixed costs. Your fixed costs are costs that usually stay broadly the same each month, whether sales are high or low. Things like rent, software subscription, insurance, salaries, internet, and even loan repayments. Step 4, list your variable costs. Variable costs are those costs that rise or fall depending on how much you sell or deliver. Example are material, packaging, delivery charges, bank charges. Then step 5, hard tax set aside. This could be VAT or corporation tax. And this is where many owners get caught out. For example, if you're a VAT registered business or you know tax is building up, include a line for that in your budget. The money may be in your bank account today, but it is not all available to spend. Step 6, decide what you are paying yourself. If you're a sole trader, that may be drawings. If you run a limited company, it may be salary, dividend, or a mix, agreed with your accountant. Step 7, add a contingency line. No budget is complete without a contingency fund. A contingency fund is simply money set aside for the unexpected. There could be a slow month, a customer paying late, equipment needing replacements, or a cost increase without much warning. Contingency fund actually protects you. It helps you absorb the shock without reaching for a high interest loan or putting personal money back into the business. Start with what we can. Even 2 to 5% of income on a regular basis that builds up over time is better than doing nothing. The important thing is to treat it as planned protection, not leftover cash if you happen to have some at the end. Step 8, total your costs and compare them to your expected income. If the number left is positive, then you have some surplus. And if it is tight, you need to be cautious. If it is negative, that is your signal to change something before the month begins. Now, let me make that way with a very simple example. Imagine your business expects to bring in 6,500 next month. You also expect 200 pounds of other income. So your total income is 6,700 pounds. Now, let's look at your fixed costs. You have rent of 800 pounds, software 1,050 pounds, insurance 100 pounds, internet 90 pounds, salaries 1,200 pounds. That gives you a total fixed cost of 2,340 pounds. Your variable costs are your material cost, which is 900 pounds, packing and delivery cost of 200 pounds, marketing expenses 250 pounds, and your bank charges is 110 pounds. That gives you total variable cost of 1,560 pounds. You then set aside 500 for tax and 150 pounds into your contingency savings. Now add all those together. That gives you a total planned outgoings of 4,550 pounds. That leaves you, now compare that with your total income of 6,700 pounds. Then it leaves you with 2,150 before any further owner's drawing, debt repayments, or investment decisions. And that is what a budget does. It turns vague pressure into a clear, visible number you can actually make decisions with. Here are a few disciplines you can adopt. Review your spending regularly. A lot of businesses carry costs for longer than they should. Software nobody uses, subscription nobody reviews, and service that made sense a year ago but do not fit into the business now. One good question to ask is this: if I was not already paying for this, would I choose to start paying for it today? If the answer is no, that cost probably needs attention. This kind of review helps you keep the budget practical and lean, especially in the early stages of a business. Use your budget every month. A budget is not something you create once and then ignore. It will become useful when you compare the plan with what actually happened at the end of each month. Ask simple question. Did income come in as expected? If not, why not? Did any spending come in higher than planned? If so, was that a one-off or is it become a pattern? You need to adjust next month's numbers based on what you know now. This review process turns the budget into a management tool rather than just a spreadsheet. Keep business and personal money separate. If you're a sole trader or running a small limited company, this point is especially important. Do not mix personal spending and business spending. Once personal and business money are mixed together, it becomes much harder to see what the business is actually earning, what is this costing you to run it, and what you need to set aside for tax. Using a separate business account and paying yourself in a more structured way makes your record clearer and your decisions better. So, if you want to build your first proper budget, start simple. Use a 1 month Use realistic income. Separate your fixed and variable costs. Include your tax and a contingency line. Then review it every month. That alone will put you in a stronger position than many business owners ever reach. If this video helped, download the templates, walk through it for your own business, and join me for the next episode in the series. Thanks for watching, and I will see you in the next one. Bye.